Okay, hi everyone. Welcome to today's webinar. So for today's session, we are going to be talking about our TDI trading strategy. This is one part of our trading strategy series, so stay tuned for more. But for this part, we are going to talk about our TDI trading strategy. And if you have any questions throughout the webinar, feel free to just pop them into the chat and I'll be happy to answer those. So we'll give you a couple of examples on how you can use this trading strategy. So let's just go ahead and get started. Okay, so obviously before we get started, as per usual, a risk warning and disclaimer. Our products are traded on margin and carry a high level of risk. And it is possible to lose, sorry. Okay, it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. So I'm your host, I'm Melanie, and I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to briefly do an intro on Traders Dynamic Index, or TDI, how it works, how you can use it, and lastly, improving on your strategy. So what is TDI? So TDI obviously stands for Traders Dynamic Index. So it basically is a combination of three popular indicators: our RSI, or Relative Strength Index, Moving Average, and Bollinger Bands. So RSI, if you're unfamiliar, measures the speed and change of price movements, indicating overbought or oversold conditions. Some other examples that are closely related to our RSI would probably be your stochastic. Next is moving average. So there are a lot of indicators that are closely related to your moving average, such as your SMA, which is your simple moving average, exponential moving average, and the one that I prefer to use, or I use most often, is our MACD, which is your moving average, convergence, divergence, which helps you to identify trend direction and momentum. And lastly, we have Bollinger Bands, which show volatility and potential price reversals. So if you're unfamiliar with any of these indicators, let me know in the chat as well, but we will also go through some examples throughout this webinar. Okay, so let's start off with RSI. So RSI shows you the strength and volatility of the market indicated by if the current price is overheated. And it's smoothened out by our moving average. So your green RSI line is the fast line, while your red RSI line is your signal line. So obviously this depends on which software you're using to trade. It might be different colors depending. Okay, so next is Bollinger Bands. So for Bollinger Bands, these are used to estimate the oscillation amplitude. Excuse me. So these are also your trading channels. So I'll open up TradingView in a little bit and show you guys what these look like in case you're unfamiliar with them. But the key levels to define your market reversals will be level 68, which is your overbought zone, and level 32, which would be your oversold zone. Okay. So when you use a trading system that is anticipating a market move, chances are that you are either wrong or right. But you cannot be right all the time because you know that markets are irrational. And so there are times when you are right on the money, but there are times when the market will prove you wrong. So that's why it's important for you to use a combination of these indicators and not just one, like either the RSI or Bollinger Bands, but rather use both. Okay, so this is a kind of a combination of both of the indicators in one. So you can see this is what our TDI indicator looks like on our trading view chart. So how does it work? Firstly, you have the crossing of green and red lines. This is our short-term trading signal. So the buy signal is when our fast green line crosses the signal red line from below. Your sell signal is when your fast green line crosses the signal red line from above. The cross occurs often, and there are stronger signals if it crosses in the overbought or oversold region, which, as we remember, would be your 68 and 32. Okay, here's an example. So you can see the crossings. We've highlighted the crossings over here. And you can follow the chart as well. So whenever you see the red or the green line cross over each other, you can see the change in the trend in the chart as well. Okay, now crossing of red and orange lines. So these are longer term trading signals. Your buy signal occurs when your signal red line crosses orange line from below. Sell signal occurs when your signal red line crosses orange line from above. Okay, here's another example. So again, we're focusing on the orange and the red line now. So we've highlighted all these lines, and you can see again the direction, or rather the trend changes whenever one line crosses over the other. Okay, now a specific level, but this is rather rare. So a rare long time trading signal is when our orange line crosses the 32, 50, 68 level. Okay, we have a question. What are the parameters for RSI, Bollinger Bands, and moving average? Yeah, I'll get into that in a little bit. So, let me just finish this slide first. So, so rare long-term trading signal occurs at these levels. So your buy signal occurs when your orange line crosses the level from below. Sell signal occurs when your orange line crosses the level from above. Okay, and you can see here, again, we've highlighted the areas where the orange line crosses above those levels that we mentioned earlier. Okay, so the TDI trading strategy that we like to use, TDI uses several classical indicators at once, like the RSI, moving average, and Bollinger Bands. It's best to use TDI with a trend indicator, or when prices are moving upwards or downwards. And you can use this together with your support and resistance, as well as any stop loss and take profit levels. Okay, so this is how we would like to use it. So you can see that price is kind of trending upwards at the start, and then our first resistance is at this overlap level. First support is at this pullback level, and our second support is at this swing low. Okay, and at this level, we are looking at where our green line crosses over our red line. So that is our sell signal. So that's why we see prices kind of reversing off of our first resistance here. Okay, and the same thing over here, just another example for you. You can see our red line crossing over the green line here as well. And actually also our orange and red line. Okay, okay. Now let's look at how we can improve on the strategy. So firstly, like I mentioned earlier, it's important to use all your indicators in combination with each other and not just one indicator in particular. So firstly, we'll use our TDI with Fibonacci retracement. So if you're unfamiliar with any of our Fibonacci techniques, let me just introduce you to this website. Let me, okay. Okay, so if you're unfamiliar with Fibonacci retracement, especially since we're talking about that now, feel free to search up the forexarmy.com. I'll just pop this website into the chat as well. So basically, this is a website that gives you a pretty in-depth guideline on what to look out for when you're using Fibonacci retracement, how to use it, which levels to use. There are also a bunch of YouTube videos that you can watch as well. Yeah, what to look out for here, clear market structures. Yeah, so we're here, Fibonacci levels for retracement. So the Fibonacci retracement levels that we like to use are between 0 and 100, namely these levels. And so the truth is that Fibonacci retracement levels work sometimes all the time, right? So again, that's why it's important for us to find different levels that work together, as well as used in combination with your indicators. So yeah, we have some steps here. Is the market clear? Market structure clear? What's the recent trend? Any major swing lows and highs, and to connect the two extreme points, lowest and highest, like this. Okay, yeah, it'll show you when it becomes invalid as well. And we're not going to focus on the levels that are below 100 and above 100 for this session, because we're not going to use that today. But yeah, if you're interested in that, feel free to take a look at this. We also go through it pretty in depth in our Fibonacci series, so stay tuned for that as well. But I think probably the most important part would be being able to identify Fibonacci confluence areas. So Fibonacci confluence areas are areas in which two or more Fibonacci levels line up together over here, like this. And what's important about them is that price tends to be attracted to these levels, but may not be able to break past them. So you can expect prices to either bounce off of them, or if it's coming from below, can expect them to reverse off of these confluence areas. So that's why this Fibonacci is important. And bringing it back to TDI, we also like to use that in combination with our Fibonacci retracement, since we use Fibonacci to also support our first resistance, first support levels as well. Okay, so here's an example of how we use our Fibonacci. Yeah, you can see at this point, at our first resistance, we see price reverse off, just as we expected, since our green line is crossing over our red line. Next, we see prices kind of dip down, but where exactly are we going to sell until? That would be until our 61.8 level here. Okay. Okay. Next, let's talk about our second strategy to improve TDI, which would be to use it in combination with divergence. So divergence, if you're unfamiliar with what it means, you can basically take a look at this and you kind of have an idea of what it is. So it's basically when a price makes a lower low, but our indicator, so it could be your RSI, your stochastic, it should be an oscillating indicator. So your stochastic, RSI, TDI as well. And if it makes a higher low, that is a divergence. So here I have kind of an explanation on what divergence is in trading. Okay, let's briefly go through this. So divergence in trading is a technical analysis concept that compares the movement such as of the security's price and an indicator such as an oscillator to identify potential trend changes. There are two types of divergences, bullish and bearish, and a bullish divergence occurs when the securities price makes a lower low, while the indicator makes a higher low. So like previously, over here, where can I go back? Yeah. So for example, like this, you can see our price has made a lower low while TDI has made a higher low. So this is an example of a bullish divergence. And you can see price shoot up after that, both on our TDI as well as on our price chart. Okay, so whereas our bearish divergence occurs when the securities price makes a higher high, while the indicator makes a lower high. So again, you can take a look at the diagram that I've attached here. So this suggests that the upward momentum of the security is losing strength and a potential downward trend may emerge. Okay, so it's important to note that divergence is a potential early warning sign of a trend change, but not a guarantee. So that's why it's important, again, I'm emphasizing this, to use it in combination with other indicators or other technical analysis tools, such as your trend lines, chart patterns, yeah, and different indicators to confirm your divergence signal and make your trading decisions. And of course, keep up with your fundamentals as well. Okay, so here's our first example of a divergence. So I'm not using TDI here. In this example, I'm using RSI just as a basic, just to kind of understand what divergence is. It's pretty much the same concept for RSI, stochastic, and TDI as well. So for our first example, we can see that we have a bearish divergence because price is testing a key horizontal resistance level, with price making a smaller high, resulting in bearish divergence with RSI. It is a bearish divergence because on our RSI, we see price actually moving in a descending resistance line. So it caught the past two reversals correctly, as highlighted by our vertical lines and the arrows, and it forecasts that we could be seeing a reversal here as well. Okay, so the result of that is that we see our RSI has reversed very strongly, and our price has also reversed because of a combination of factors. Firstly, your horizontal resistance, secondly, RSI resistance, and lastly, your bearish divergence. Okay, pretty straightforward so far, I think. So I'll move on to our next example, which is again bearish divergence. But this one is a bit more straightforward. You can see very clearly the higher high on our price chart and the lower high that our stochastic is making. So here we see that repeated pattern when price is making a bearish divergence, higher high, and stochastic is giving us a lower high. So we also have a hidden resistance level on our stochastic. So that forecast that price is going to reverse really strongly over here. Yep, since it recently reversed off of this strong resistance level. You can see that's exactly what happened here. Okay. Okay. So if we're looking at an example using TDI, you can see it's pretty much the same as what we've been talking about on our RSI and stochastic. Price is making a higher high, TDI is giving us a lower high, so you can see price drop after that. Okay, I think that's pretty straightforward. Okay, our last strategy to use in combination with TDI is your Ichimoku. So let me know in the chat if you guys use Ichimoku often when you trade, because for me personally, Ichimoku and MACD are the two indicators that I use most frequently, because at one glance you can see exactly what the signals are. Okay, so if you've never used Ichimoku before, I'll do a really quick introduction to Ichimoku here. Yeah, so in this example, you can see the parts where we've highlighted. Where price is crossing below the cloud, it's giving us a bearish signal. And you can see it kind of matches up, because when price crosses below, you see our green line cross over our red line, which, as we remember, is also a sell signal. Now here, if we look at our second highlighted area, you see our green line cross over our red line again, and we also see price crossing below our Ichimoku cloud. So again, it's a bearish signal. So we have both TDI as well as Ichimoku confirming that kind of downtrend signal. Okay, so if you've never used Ichimoku, the way that I use it is like what I've described. Basically, if it's above the cloud, it is a buy signal. If it's below the cloud, it is a bearish signal. So, but if you want to know the different lines, which if you're just starting out, you should probably understand different lines as well. You can see the blue line is your conversion line, the red line is your standard line, green line is your lagging line, and then we have the cloud as well. Okay, so I'm not going to try and pronounce the Japanese words. So yeah, so I'm just going to describe the colors, but of course, again, the colors might be different depending on what software you use. So here we are using TradingView. So the screenshot over here is from TradingView. That's why we are going by those colors. So blue and red are used to identify the trend of the market. A bullish trend occurs when the blue line crosses above the red line. And a bearish trend occurs when the blue line is below the red line. Okay, I think it's pretty clear here where our lines cross over and where there is a change in trend. So I'm not going to dwell too much into that. And next, we're going to look at the support and resistance. So again, you can use this to support your graphical levels for your support and resistance, and to identify any entry points, exit points, take profit levels, so on and so forth. So for the Senko span A and B, here we are using the green and the red lines. Okay, but if these are used to determine your support and resistance levels, and these basically outline your cloud. So if the price is above line A and B, then it's considered a bullish market. If A and B, so that A and B can act as support levels. And if the price is below A and B, then it's considered a bearish market, and A and B act as resistance levels. So it's pretty much the same concept as what I mentioned about the cloud. Yeah. So here is A, here is B. Here's them together. Okay, so these basically outline your cloud. Yeah. So yeah, here's the cloud. So yeah, now the last step to this is your confirmation. And this is the Chico span, and it's used to confirm the signals generated by the Tenkan Sen, Kijun Sen, and Senko span. If the Chico span is above the current price, it confirms a bullish trend. And if the Chico span is below the current price, it confirms a bearish trend. So the Chico span here is basically the blue line here, and the rest of the lines we've mentioned earlier already. Okay, so now the most important part, I think, would be your buy and sell signals. So Ichimoku generates your buy and sell signals based on the positions of the various components. For example, a buy signal is generated when the Tenkan Sen crosses above the Kijun Sen, and a sell signal is generated when your Tenkan Sen crosses below the Kijun Sen. So like this. Again, your Tenkan and Kijun Kijun Sen. Um, if you want to just backtrack a bit, these are your blue and red lines. Your Senko span A and B are basically your leading indicators. Okay, just if you're a bit confused. Okay, so here is the parameters that we use for Ichimoku. There was a question about the parameters that we use for the other indicators, and I'll get into those in a bit. But for Ichimoku, yeah, these are the inputs that we use. Okay, now, yeah, so here's, um, yeah, depending on your strategy as well. Okay, so how to use the Ichimoku effectively? IKH stands for Ichimoku Kinko Hyo. So yeah, so it's just basically your Ichimoku. So the overall trend is up when the price is above the cloud and down when the price is below the cloud. Trendless or transitioning when the price is within the cloud. So that's basically what I was mentioning earlier. So traders will use the Ichimoku cloud as an area of support and resistance depending on the relative location of the price. Cloud provides support and resistance levels that can be projected in the future. So the area of the support and resistance levels that we are using was what we mentioned earlier. The Senko span lines are leading lines. And this sets Ichimoku Cloud apart from many other technical indicators that only provide support and resistance levels for the current date and time. Okay, so yeah, here's how we use it. Basically, you can see really clearly when price moves below the cloud, it's a bearish signal. If it moves above the cloud, it's a bullish signal. Okay, pretty straightforward there. So that's how we use TDI in combination with our TDI in combination with Ichimoku. Okay, let me just pull out my charts now. So someone asked what our parameters are, right? Okay. So let's just look at Aussie dollar since I have it out now. Let's look at RSI first. Okay, so for RSI, it measures the magnitude and the speed of price changes within a certain period. So if it moves above this level, it is overbought. If it moves below this level, it is oversold. If you want to see, yeah, so these are our inputs for RSI. Okay, for moving average, we normally use the 3-day EMA. Yeah, so your length for EMA would be 3 days. Let me exponential. Again, this depends on your time frame. So obviously if I'm using a shorter time frame, my inputs will change as well. Now that I'm on a daily time frame, I wouldn't want to use a 3-day time frame. Probably 4 hours or even 1 hour might be better. Okay, so that it's clearer to see where prices cross over our indicators. Okay, but for Bollinger Bands, okay, we just use these inputs. Okay, so for Bollinger Bands, the bands will widen when the price of your security becomes more volatile, and it'll contract when it becomes more stable. So you see here that prices are pretty volatile, so they are fluctuating quite a bit. Another way to use Bollinger Bands is when prices break below the lower band, it is a sell signal because it's kind of a signal that prices are going to drop. And if prices cross over your if it starts to break above the upper band, that is a buy signal. Okay, but also there are Bollinger Band squeezes, and you can look those up online as well. So there are a lot of different ways to use your indicators, and not going to get into all of those now. But yeah, just to go through some ways to use these different indicators in combination with your graphical analysis as well as your trend indicators as well. Okay, any other questions? Mm, any requests for any charts you'd like me to go through? So this is an example of your TDI. Okay, and you can kind of see where the lines cross over each other. Um, so again, RSI is used here. So for RSI, we're looking at the green line as well as the red line. Okay, I'm gonna get rid of this RSI. Okay, and for Bollinger Bands, how we use it is we look at the 68 level, or 70, okay, and 32, which is your oversold level, or 30. Okay, I'm just gonna change this to what we used earlier. I want to look at 32 and 68. Okay, so your overbought zones are above this level, and your oversold zones are below this area. Okay, so again, if you're a bit confused, I'll show you how it works again. Okay, we see prices increase up here when our prices, or rather when our green line crosses over our red line. Okay, are there any questions so far? Okay, if not, that brings us to the end of our session. Yep, thank you guys so much for joining me today. I hope you guys found this session helpful. If there are any questions, feel free to pop them into the chat and I'll stay a while to answer those. If not, yeah, thank you guys so much for joining me. Have a great rest of your week, and I'll see you guys again next week. Thanks, everyone. Bye. Bye, guys. Thank you.